Welcome back to the deep dive. Today we are doing a really high-stakes, time-sensitive analysis. We're focused squarely on the German stock market, specifically the DAX index. And we're not just giving a forecast, we're charting a navigational risk and opportunity map for the final intense few weeks of 2025, right up to the end of the year.
That's the mission. And given that today is November 21st, 2025, every single trading day matters. We're trying to move past all the general market chatter and really extract precise financial indicators, critical technical boundaries, and the specific macro triggers from our sources.
The goal being to give you a comprehensive, actionable risk map for this, for this very concentrated finish line.
Exactly.
And what I think really sets this analysis apart is the methodology. We're dealing with three very specific probability-weighted scenarios. These are grounded in concrete technical levels, and most importantly, they're refined by some pretty sophisticated quantitative techniques. We're talking about Monte Carlo simulations here. This is a data-driven approach for an extremely high-stakes period of volatility.
It has to be. We need to understand not just where the market could go, but how the mathematical probabilities actually stack up against each potential outcome. So let's just dive right in and unpack this using the three primary scenarios from the analysis, starting with the distribution of risk.
Okay, let's talk numbers right out of the gate. We have three paths, but what's the confidence level assigned to each one?
The probabilities were pretty starkly divided. The base scenario is assigned a 50% probability, so that establishes it as the most likely course of action. The remaining 50% is then split equally between the bull scenario and the bear scenario at 25% each.
Hold on. If I'm reading that right, we have a 50% chance of stability and a 50% chance of an extreme defining move, either up or down. Doesn't that mean we should treat this period less like a gentle consolidation and more like a binary high-risk situation where half of the possible paths lead to significant triumph or, potential pain?
That is a fantastic way to frame the risk. And while mathematically, yes, it's 50-50 for extremes versus the base, the consensus analysis suggests the 50% base case is the path of least resistance.
Because it requires the fewest external shocks.
Precisely. It assumes the status quo holds. Whereas the bull and the bear cases, they require specific high-energy catalysts to actually fire.
Okay, so let's define that crucial 50% base scenario. What specific port target are we looking at, and what market conditions justify that high probability?
The target for the base scenario is centralization around 24,000 points. Let's say sitting within a tight range of 23,500 to 24,500. The underlying assumption is basically consolidation driven by mild internal stability. We expect a gradual, slow recovery in EU consumption, exports that remain stable or maybe just slightly growing, and the critical piece, a stable ECB monetary policy.
Meaning they just hold steady.
They hold steady. They're assumed to maintain their current stance, focusing on supporting stability rather than surprising the market with any rate hikes. If this holds, you should expect moderate, persistent movement, but nothing dramatic toward year-end.
All right, now let's turn to the optimistic case. For that 25% bull scenario, what needs to happen to push us toward 26,000, and what does that target range look like?
The bull target is significantly higher, you're right. It's aiming for 26,000 points, potentially covering the 25,000 to 26,000 range. And achieving this requires a very specific macro cocktail.
A macro cocktail.
Yeah. First, we need a significant confirmed recovery in global demand, specifically from the U.S. and China. Second, a noticeable uplift in German industrial export orders. That's the lifeblood of the DAX components. Third, we need the ECB to remain accommodating. But perhaps the most potent element is a structurally weaker euro versus the dollar.
Can we quantify that currency leverage? I mean, Germany is an export powerhouse. How significant is the Euro-USD movement to the profitability of a major DAX company? Are we talking about a minor shift, or does it take a huge move in the exchange rate to justify that 26,000-point climb?
Oh, it's highly impactful because German giants like Mercedes and Siemens, they earn a huge portion of their revenue in dollars, but their costs are in euros. So a weak euro acts like a permanent competitive discount. It inflates their repatriated profits immediately. A sustained shift of even just a few percentage points in the USD rate can directly translate into substantially improved earnings guidance for the next quarter. And that is exactly the catalyst needed to power the index toward that 26K resistance level.
That really brings the scenario to life. Okay, now let's flip the coin. Let's talk about the 25% bear scenario. If the global economy starts to cough in the next few weeks, what's our floor?
In the bear scenario, we'd anticipate a correction toward 20,000 points. And potentially, it could dip as low as 19,000 in an extreme stress case. The risk factors here are, well, they're predominantly macro. worsening global demand, a sudden flare-up of geopolitical tension that disrupts supply chains, or the most dangerous monetary risk, a sudden, unexpected worsening of inflation forcing the ECB to immediately tighten policy. Our analysis repeatedly points out that the greatest domestic vulnerability lies in a persistent deterioration within those critical export segments.
So we have our destinations. Now we need the technical map, the boundaries that tell us which scenario is actually winning. What are the key resistance and support levels we need to be monitoring, maybe even hourly?
These technical markers are really the operating instructions for risk management. Let's look at the upside first. Our immediate short-term resistance sits firmly in the 24,600 to 24,800 band. What's critical here is that a sustained, high-volume breakthrough above 24.7K is explicitly cited as the confirmation signal.
A confirmation.
Right. That level acts as a psychological and a quantitative gatekeeper that once you clear it, opens the path toward the higher 25K, 26K bull target.
So 24.7K isn't just a hurdle, it's the launch pad for the bull case. What's the ultimate ceiling if that scenario truly takes hold?
The stronger resistance is set right around 26,000. That is the absolute bull target defined by the scenario. Overcoming that level would signal a major sustained injection of market confidence that currently sits, a bit outside our 25% probability range. It would hint at a truly unexpected acceleration of global economic recovery.
Okay, now let's zoom in on the floorboards, the support levels. Where do institutional players tend to draw their lines in the sand on the downside?
We have immediate near-term support at 23,500 to 23,200, which reflects the current recent daily lows and intraday consolidation. But the real line in the sand, the level that matters most, is the stronger support at 22,000.
Why does 22,000 carry so much significance for the market right now? It sounds like it's more than just a number.
It is much more than a number. 22,000 is a crucial psychological and technical junction. It represents the ceiling that the market broke out of earlier this year, probably back in Q2. When the market falls back to a previous breakout point like that, it becomes a point of maximum defense for institutional players who initiated large, long positions there. If 22,000 is breached, it signals a complete failure of that earlier momentum, and a lot of large funds will be forced to de-risk, which dramatically increases the probability of that 20K bear scenario playing out.
That explains the defensive urgency around that level. Okay, let's talk about the operational data that could trigger these moves. What are the day-to-day warning signals that tell us we're leaving the 50% base case?
We have three core triggers you have to track. The first and the most immediate is DAX component results. We must obsessively track the monthly or quarterly earnings and guidance revisions from the major industrial and tech components: Siemens, Mercedes, BMW, SAP, Infineon.
Those are enormous global companies. Why do their individual reports hold such disproportionate power over the entire index?
It's because the DAX is a cap-weighted index. It just means companies with the largest market capitalization have the largest influence on the index's movements. So if the 3 or 4 giants, like an SAP or a Siemens, all revise their growth guidance downward in quick succession, the index will crash far faster and harder than if 20 smaller components revise downward. These companies are the structural core of German economic health, and their forward guidance is the quickest indicator of whether the bear case is gaining momentum.
That's a critical mechanical insight. What's the second trigger?
It's the broader health of the economy, specifically German economic data. We're focused on exports and industrial production figures. Clear signs of an accelerating decline in manufacturing orders or outright recessionary signals will structurally increase the probability of a swift descent toward 20,000. This is the fundamental link back to the global demand element of the bear scenario.
And the third trigger, which is always waiting in the wings.
Monetary policy. We are watching the decisions by the ECB and, of course, the underlying inflationary data. If, against current expectations, inflation were to unexpectedly re-accelerate globally and force the ECB to signal further tightening of rates, that would exert immediate and heavy downward pressure on the DAX. German stocks are extremely rate sensitive, and a hawkish pivot is the quickest way to derail that 50% base case.
Let's pivot to the quantitative evidence that supports or refutes these scenarios, the Monte Carlo simulations. For those who aren't familiar with this technique, how should we conceptualize it?
Okay, so think of Monte Carlo simulations as creating a detailed weather map of risk. It's not a single forecast. It's running tens of thousands of potential market trajectories based on historical volatility and current inputs to show us the probability distribution of outcomes. It tells us where the market is most likely to cluster.
And what did the model show for this specific short period between now, November 21st, and the year end? Does the math support your 50% base case?
It absolutely reinforces it. The simulation centers to the point where the largest number of trajectories end up is close to the current level, confirming our base scenario target right around 23.3K. The model agrees that moderate consolidation is the most probable path.
And how realistic are the extremes according to this data, specifically that 26K bull target and the 20K bear target?
For the extreme bull scenario, major growth above 26K is given a very low probability. It registers only a 3 to 4% chance. However, a breakthrough above 24K, let's call it a bull light scenario, is considered much more realistic. It's sitting at approximately 32% probability, with the upper quartile of the simulated distribution landing at 24.3K. So a modest push up to the base target ceiling is viable, but a runaway rally is, well, mathematically remote.
And what about the risk of a collapse toward 20,000? How worried should we be about a deep correction?
The good news is that a deep correction below 20K is deemed highly unlikely, registering less than a 1% probability. However, and this is important, we cannot ignore the possibility of a bear light scenario. A moderate correction below 22K has a non-negligible risk, landing at approximately 17% probability. And this convergence is fascinating. It shows that while a catastrophic collapse is remote, a substantial descent back to test that critical institutional defense level at 22K remains a very real threat.
That 17% probability of dropping below 22K is incredibly specific. It provides a real numerical weight to that technical level. So let's connect this quantitative risk directly to action. What does all this mean for you, the listener, if you're holding long positions right now?
The primary advice derived from the convergence of these technical levels and the probabilities is focused on two areas: position sizing and protection. Since the downside risk of hitting 22K is a concrete 17% probability, you must size your current exposure accordingly. This is a time for active defense, not passive holding.
When the stakes are this high, what is the most common mistake traders make in this specific scenario?
The most common mistake is failing to honor the crucial support lines. They set a mental stop loss but don't execute it, hoping the price will magically recover from that 22K level. The quantitative data dictates that if you are wrong, you will be wrong fast.
So, practically speaking, what specific defensive measures should be implemented right now?
Utilize dynamic stop losses. Place them strategically just below those critical support levels. Specifically, you want to target the 23.2K near-term support from minor pullbacks, but the most important safety net is just below 22,000. Breaching that 22K institutional defense point is the moment that 17% chance of a bear-like correction becomes the dominant reality, and that requires an immediate reevaluation of all your long sizing.
And what if someone wants to hedge their current long exposure without selling out entirely?
That's prudent. You could consider employing protective strategies, things like short-term put options, and you'd maintain that protective posture until we see a clear and confirmed breakthrough above the strong resistance levels. The simulation confirms you should only consider significantly increasing exposure upon a confirmed high-volume breakthrough above that 24.7K to 25K resistance zone, because that's the confirmed signal for the 25K to 26K target range.
This has been a complete roadmap for navigating the final sprint of 2025. So to briefly recap, we're anchored in a consolidation period with a 50% probability of hitting the 24K mark.
That's the baseline. But the crucial takeaway is not the destination, it's the journey markers. You have to monitor that 24.7K resistance on the upside and the 22K support on the downside with high vigilance. And remember, the quickest catalyst for any shift will come from the earnings and guidance revisions of the German cap-weighted export giants.
Absolutely. The Monte Carlo simulations provide us with this beautiful map of probabilities, but they are not guarantees. And this leaves us with an important question for you to consider as you digest this analysis. In a high-stakes environment like this year-end sprint, how effectively can you blend the precision of pure probability models, like that 17% chance of dropping below 22K, with the sudden, high-impact force of real-world fundamental catalysts? Things like an unexpected ECB shift or a massive single earnings disappointment from a major DAX company. The integration of quant models and qualitative triggers, that's where true risk management lies.